If you look at the math, we're going to put about 220 million doses into the market by the end of March. And if J&J gets authorized, which I think they will, that'll be another 30, maybe 40 million doses. So figure 250 million doses by the end of March. And if a 60-40 split occurs, meaning 60% are first injections, 40% are second injections, which is probably about right, that's around 150 million people that will vaccinate between December and the end of March.
That was former FDA Commissioner Dr. Scott Gottlieb earlier today on CNBC. And look at what played out in the market. Stocks hitting record highs, with the Dow, S&P, and NASDAQ all closing at their highest level ever. The reopening rally playing out today, especially in the airlines. Green arrows across the board there for the group. So let's trade it. Tim, you flagged this soundbite, I should say, earlier on our call. And this would imply that maybe people are underestimating how quickly the economy could come back.
Well, again, if you look at the airlines and where we've been moving in the evolution of that trade, just from balance sheet dynamics to recovery to actually, where you start to look at some normalized earnings, I think very, very interesting. And yeah, I think that was a captivating interview and it was obviously fantastic for the world and for our country. The pent-up demand around vacations. I like some of the hotel chains. I like actually Hilton Grand Vacations, HGV, because I think this is a company, and you see this from other players as well, permanent savings out of COVID that have been squeezed out of their business. And I think profitability that's already been guided to be much, much better than expected for 2021. So some of these trades have had a very big move, but some of these trades have been waiting for these types of segments. And Dr. Gottlieb, I think, gave us all a lot of reason to be bullish.
Guy, do you think this is what rates are telegraphing?
Absolutely. I think that's a huge part of it, without question. And I think, to me, that's the big concern for the back half of this year, if not before, is that rates go higher than people expect. And, I'm probably in the minority in that one, but I absolutely think that's what's going on. And the fact, again, getting back to the Fed, that they somehow think they can not control it, but let it sort of sideways to slightly higher over the course of however many years, I think that's just foolish. So I think that's what's going on. And we played a game, I think, towards the end of last year. What's the acronym for 2021? And I know it was made fun of, as I typically am, but hope was mine. And some of those names, look at Expedia. I mean, that's probably going to test the levels we saw in June of 2017. Palantir's been a monster. Home Depot probably close to its all-time high. And even Oracle seems to be getting off the mat. So there is hope out there. And I think it's going to manifest itself in exactly what you said, rates going higher in a meaningful way over the next few months, Mel.
I mean, we've got records for the stock market. So Dan, how do you think about this reopening trade? Is it buy the rumor, sell the news kind of thing? Because then we could actually be in for a pullback.
I think Tim made a really good point about these companies in these areas that really had balance sheet impairment. They had to sell really expensive equity. They had to take a bunch of loans, obviously, in the airlines. But look at a Disney today, up 4.5% or so, making a new all-time high. And you tell me, if last year they lost, their sales were down 20% year over year. Their earnings were down 60-some%. No real big balance sheet issues. What is that discounting? So I think you have to be really careful and say, okay, well, they were actually discounting the fact that, they're going to be back up and running with all of their business units with maybe, I don't know. So I guess my point is like, do airlines have a lot of ways to go? Yeah, but I suspect that there's going to be some consolidation and there's going to be a few more hits. I don't think they're going to recognize a lot of cost savings. If anything, it's going to be a lot more expensive, because even if we do have 100 million people or 150 million people vaccinated by the spring, the costs associated with running an airline or a hotel or a lot of these other stuff are going to be around for a long time, in my opinion.
All right, our next guest believes reopenings coupled with a supercharged economy will boost stocks even if interest rates continue to move higher. Jonathan Golub is a chief U.S. equity strategist at Credit Suisse. Jonathan, great to see you.
To be here.
So you're also in the camp that believes, like our traders, that the second half of the year is going to be a big one for the economy. Will it be an equally big one for the stock market, or will we do that in advance?
Well, first of all, I don't know exactly what the inflection point is, but between now and the beginning of the fourth quarter, I just don't see anything but stocks being higher and the backdrop getting more and more favorable. And I think that this whole argument that rising interest rates are in some way a problem is I just think it's going to be proved to not be. We just put out a research note which shows that on days where interest rates go up, stocks go up with it, and cyclical stocks go up the most. On days where credit spreads go down, that's good for markets. On days where inflation expectations rise, the market actually wants a bit more inflation. The data is pretty clear on that. So we don't see a threat there, and we think this reopening is going to be big.
Yeah, Jonathan, and all those points make great sense. And, I think that's the hope for a lot of people, that these things just continue to move in an orderly fashion. But I know as an analyst and as somebody that does this for a living, as an economist, you have to sort of forecast what can go wrong. So what can go wrong under this scenario?
So, first of all, there's the obvious thing which everyone's talking about, which is, maybe as we have this virus continue to, morph over time, the vaccines won't work. And that's, for all of us on the show, impossible for us to really predict how that's going to go. But the thing which has me concerned is that this is almost like too much. The level of stimulus, we put $5,000 extra in every American's hands, $3,500 from money coming from the government, $1,700 that they have because they haven't been able to spend. The wealth effect is enormous. If you held bonds, they're up in value, stocks up in value, real estate. And so when this thing is going to reopen, it's going to be huge. We've been caged up. And do we really need, in addition to the $900 billion extra we just got, another 1.9? I don't want to see so much stimulus that we run the risk of having a real inflation problem as we move into next year. The tips market, the break-evens are predicting 3.5% inflation by the end of this year. I'm not saying that's going to happen, but to a certain extent, that represents a risk that we're almost pushing this towards overheating at some point in time. But for now, definitely too early to make that call.
Jonathan, Tim, share a lot of the bullish backdrop that you've put out there, but when do markets pay for the normalized earnings? We've not cared, right? So the minute, to me, we have that pent up and we have to look and say this is normalized or bust, valuations make no sense.
I'm not so concerned about the valuations. If you look at it, and I don't want to get too wonky here, but the PE multiple in the market at something like 22 is high. There's no other way of looking at it. But if you look at the amount of free cash flow that you're getting out of the market, it's enormous. And so the price to free cash flow, or the price to the return of capital to shareholders, looks very much in line with long-term averages, and we have a much lower cost of capital. So I think that we're going to be able to maintain multiples at these levels. And my prediction is that over the next 2 or 3 years, we'll probably see PEs on the market at 25 or higher. And I know that sounds like a crazy number, but it's driven by fundamentals. So I don't think this valuation argument is going to be the thing. I do think an overheating economy and us pushing this too far, too fast, and the speculative nature of some things going on is reason for concern, though. Jonathan,
thank you. Appreciate it. Jonathan Golub,
my pleasure.
Credit Suisse. Karen, are you worried about inflation and the economy just heating up faster than we expect later on?
Yes, I am. I have a number of inflation bets on them. One of them actually would be Bitcoin, but also I think the banks will be beneficiaries of that. Then I have some more sort of wonkier ones. But I am very optimistic on the reopen trade, and I think that there is still room to run in some of the names. I think we'll be surprised to the upside about how strong demand is. And when you think about it, if that happens in the next 2 months or so, and you have the stimulus. So for me, names like an Ulta or a Starbucks, even some, I don't own Foot Locker anymore, but something like a Foot Locker. And then I have the ultimate reopen trade, I think, which is Live Nation, which by any metric is expensive, but I think we will just see a gigantic second half for them. So I'm hopeful, and I do think inflation will happen, but I'm going to worry about that a little bit later.
Yeah, or maybe we shouldn't worry about that at all. Even if Jonathan, he pointed out the tips market pricing in more than 3% inflation by the end of the year. Even if that happens, Jerome Powell guy has said repeatedly he's not thinking about. I don't know how many thinking abouts there are. I think it's 3, raising rates. And so, what wins out? Knowing that the Fed is not going to do it, or the market doing it for the Fed?
Well, the hubris associated with that comment, it's beyond, well, I find it to be almost laughable that he'll say something like that, because embedded in that is his belief that they somehow can control it, or it can be controlled by forces, which I think is preposterous. I think you better hope it stops at 3.5%, I guess is my pushback, because I think we're going to be well north of that in the back half of this year. And once that genie's out of the bottle, we've seen it before, you can't put it back in. And that's the existential risk to this market. Runaway inflation, and yes, I'm using that term, because by the way, inflation is here, they just choose not to measure it. And the dollar getting torched like a white owl, as they say, for those of you that smoke out there.
Dan, last comment here.
Yeah, a lot of complacency, a lot of moving the goalposts. People feel pretty certain about what's going to happen here. There was a Bloomberg story on Friday talking about how money managers can't get their hands on enough of high yield, junk, levered loans that they're actually calling companies asking them to borrow, okay, before the deals even come to the tape. I'm just telling you, it's not normal. You can kind of put it in whatever pocket you want of the, your investment thesis. This is not normal. And maybe everything's changed, but I'm just telling you that a lot of the stuff that I'm hearing sounds like crazy.
Shepard Smith here. Thanks for watching CNBC on YouTube.